Wall Street doesn't sleep because it wants to. It's been it's being forced awake. For more than a century, global capital bowed to one thing: New York's clock. News could break anywhere. Power still waited for the opening bell. That era is ending. Nasdaq has filed to trade 23 hours a day. Clearing houses are preparing for non-stop settlement. Banks are panicking quietly. This isn't about convenience, it's about who controls price, time, and power in the next financial order. Let's strip this to facts. Nasdaq wants to extend weekly trading to 23 hours, and New York Stock Exchange is already approved for 22-hour trading on ARCA. DTCC, the backbone of US markets, is preparing 24 into 7 clearing by 2026. This isn't a proposal anymore, it's infrastructure being laid. When clearing goes non-stop, markets follow. You don't pause a river after removing the dam. Wall Street banks are saying the right words: investor protection, liquidity risk, volatility concerns. That's not the truth. The truth is simpler. Banks were built for end of day processes, human supervision, batch risk management, office hour capitalism. 24 trading destroys all of that. Risk doesn't wait, margin calls don't pause, losses don't respect sleep cycles, and worst of all, profit extraction becomes harder. When markets run continuously, speed replaces relationships, algorithms replace sales desk, precision replaces persuasion. Banks don't fear volatility, they fear irrelevance. Critics keep repeating one argument: overnight liquidity is thin. Correct. And that's exactly the point. Thin liquidity means wider spreads, faster market impact, higher volatility. This market will not reward patience, it will reward capital, code, and conviction. Thin markets are where empires are built, not avoided. Every dominant market maker in history, from oil to forex to crypto, entered first when liquidity was weak. They didn't wait for safety, they created dependency. Let's be clear about winners. Ma- Market makers win. Firms like Citadel, Jane Street, Virtue, algorithms don't sleep. Risk is continuously hedged. Data components, data compounds every second. When Citadel says we'll be there, that's not reassurance, that's a warning. Exchanges win. More hours mean more data, more flow, more relevance. Retail platforms win. Global users, event driven trading, engagement based models. And now the losers: traditional banks, slow institutions, committee driven capital. If you need an approval at 9 a.m. Eastern Standard Time, you don't belong in a 24-hour market. This isn't about trading stocks at night, this is about who controls price discovery. For decades, Asia reacted, Europe positioned, and New York decided. That hierarchy dies when time disappears. When markets trade continuously, geography weakens, jurisdiction blurs, sovereignty erodes. Capital stops asking permission. That is why regulators are quietly allowing it. Not because it's safe, but because stopping it is impossible. Once time is gone, everything accelerates. 24 into 7 clearing, tokenized equities, atomic settlement, AI driven liquidity, cross border continuous markets. At that point, markets stop being venues, they become infrastructure. And infrastructure always belongs to those who built it first. Here's the reality: Wall Street won't say out loud. This will not explode in 2026. It will feel awkward, thin, noisy. In 2027, liquidity pockets form. 2028, dominance consolidates. By the time banks fully adopt, the toll roads will already be owned. Markets don't reward caution, they reward early control. Time was the last illusion of stability. It's gone. 24-hour trading isn't progress, it's exposure. Those who master continuous markets won't just trade better, they'll decide what price even means. And in finance, whoever defines price controls reality.